When investment markets decline, our stomachs start to overtake our brains in terms of making investment decisions. And this was definitely the case when I first started investing. But over time, a long time, I developed a framework that helps me manage my emotions so that I stick to my long-term investing plan. And that's one of the most important things that we can do as investors: stick to the plan. But that is so much easier said than done. So in this video, I'm going to share with you some mental scripts that I use that help me stay invested. Hey everyone, my name is Preet, and this channel is for anyone who wants to learn more about the world of money around us. Now, if you're like me and have many years in the accumulation phase of your life ahead of you, you might start to see market downturns as a good thing by the end of this video. Now, there is one big caveat. I want to be clear that this video is really only for investors with properly constructed portfolios in the first place. I'm talking about tried and true traditional portfolios where your time horizon, your risk tolerance, your financial capacity to handle losses, whether your financial situation considers if you even need to take on a certain level of risk or not to hit your financial goals, and your portfolio objectives are all taken into account. And based on all of that, you have a globally diversified, properly allocated portfolio that is appropriate for your situation. None of what I talk about in this video applies to cryptocurrencies, NFTs, meme stocks, or day trading.
You like apples?
If you are in those categories, you should still watch this video, and maybe you'll find that a more traditional long-term approach might be worth considering. I'm recording this on May 15th, 2022, and many markets have been having an awful time, but I have no idea where the bottom is. Is it just a dip? I don't know. Is it just the tip of the iceberg? I don't know. It's possible that we are at the beginning of a lost decade of returns, and that would not deter me in the slightest from sticking to my plan. This is an evergreen video, and you can come back to it anytime the markets are making you nervous, as nothing in this video speaks to the current possible causes of what's causing the market mayhem. The noise of the day is always different, but the prescription is always the same. So here are some mental scripts or mental models that I use to help me avoid worrying about short-term noise and doomsday predictions so that I can stick to my long-term plan. Mental script number 1. For prices to go down, someone needs to be buying. All shares being sold are also being bought, because you can't sell unless someone else is willing to buy. And it strikes me that the person doing the buying is more likely to be the successful long-term investor. I want to be that guy. Now, when you look back at stock market charts and identify the corrections and crashes, it's of course easy in hindsight to see that broad-based indexes have always recovered. It's clear in hindsight that sticking to the plan would have been better than selling out of fear. But at the time, it's always super scary. At least it was, until I used this mental script to flip my perspective. This is probably the one that has had the most impact on controlling my emotions about market downturns. This has helped me view market corrections and crashes as friends to the long-term investor, which leads me to my second mental script. I get to buy retirement income at a discount. It's pretty common to hear people say the market is on sale when you have a correction or a crash, but the abstract nature of an investment portfolio can make that hard to rationalize. For example, let's say that you go grocery shopping every week, and every week you buy a can of tuna, and every week that can of tuna is $2. One week you see that the can of tuna is on sale for $1. You're not less likely to buy that can of tuna. You're not all of a sudden afraid of tuna. You're more likely to buy it. You might even double up. That makes sense to us because we know what we're getting. It's not abstract, it's tuna. And all other things being equal, a lower price is more attractive. Investments and investment portfolios are very abstract, especially when you're just starting your investment journey. I can't recall ever meeting anyone who felt super confident about investing when they first started, and that includes me. There's always a bit of a leap of faith when starting, and for many people that faith component never really goes away because there is always uncertainty about what they've bought, because investment portfolios are just more abstract than buying goods and services that we consume on the spot. We know what we're buying when we buy tuna or whatever. I'm not super into tuna or anything. But with our investments, if we're not 100% clear on what we are buying and holding in the first place, then when those values go down, that uncertainty turns into fear. We don't naturally see markets as being on sale when investments are down, and that's why the on sale analogy just doesn't really resonate with everyone. So the mental script that I use on this front is that what I'm buying today when I invest is my retirement income tomorrow. Over long periods of time, it's a very reasonable assumption that markets go up. Just look at any long-term chart. This is not news. The short term is very volatile at times, but even if you started investing at a bad time and ended your accumulation phase at a bad time, so long as your time horizon is very long, you'll be up if you just stick to your plan and invest regularly over time. Again, not news. My portfolio balance way down the road is going to be one of the sources of my retirement income, the primary source of my retirement income. So I look at it less as an investment portfolio per se, and compartmentalize it as my future retirement income. Now that's still a bit abstract, but by mentally labeling it, by compartmentalizing it as something more than just a collection of securities, it feels different. It feels less abstract and more like something that I just want to buy more of. And I'm happy to buy it when it's offered at a discount. Mental script number 3 that I use to help me become more comfortable with volatility and stock prices in general is the quote from Gary Schilling that the stock market can remain irrational a lot longer than you or I can remain solvent. And what this quote means is that at any given moment in time, the market might put a value on a company that doesn't seem to make any sense. And this mispricing can exist for a long time. Many years ago, when I was a stockbroker, I remember the following analogy which really stuck with me and helped drive this idea into my head. Imagine that you have 10 people who've decided to put their money together to start a private business. They each put in $100,000 for a total of $1 million. The business takes a year to generate sales, and maybe after year 3 starts to make money. And by year 5, it's turning a profit of, $200,000 per year. Very successful. But let's say that investor number 1 has some kind of personal emergency. Maybe they're getting divorced at the same time their kids are going to college, and they just need cash. She could go to the partners and ask if they would buy her out for $200,000 for her 10% share. That would value the company at $2 million. And based on the financials, this might be more than a fair deal. But imagine that the partners had a falling out over time and they don't like her anymore. They could be pricks and say, you know what, we're not going to buy you out. Now, she could go back and offer her share for her original investment of $100,000, and they might still say no. If she was desperate, she might ask for $50,000, taking a real haircut on her share, but she needs the cash. They agree and they buy her out. Now, because the last transaction took place at $50,000 for 10% of the company, the whole value of the company, if this was the stock market, would be $500,000 because you calculate the value of a company based on the last price executed at times the number of shares. But everyone knew that the real value of the company was likely over $2 million. That $500,000 valuation was just completely detached from reality. This hypothetical example helped me really understand the idea that investments can be wildly mispriced for very odd reasons. There's a great Twitter account called 10K Diver, which had a thread talking about volatility and risk, and part of their analogy gave an example of a person walking a dog. And sometimes the dog would race ahead of the owner, and sometimes the dog would fall behind, but was anchored, or leashed, to the owner over the entirety of the walk. I see markets the same way. I don't think I can reliably or consistently beat the market based on this view, but it helps me to be at peace with whatever it's doing at any one time, knowing that eventually we end up where we want to be. Right now, maybe the market has seen a squirrel and has gone nuts, that's all. Mental script number 4. The news headlines aren't talking about your portfolio. If you go to a business news website or report, they tend to tell you how individual indexes are doing that day. The Dow is down 3% today and 15% for the month or whatever. Those headlines tend to quote single indexes, which are 100% equity. Most properly built portfolios are 1, diversified beyond a single market, and 2, have exposure to multiple asset classes, not just US stocks. If we compare the S&P 500 against a balanced portfolio, we see that the balanced portfolio is less volatile. From the beginning of 2020, which includes the market drop at the beginning of the pandemic when the world came to a halt, the S&P 500 was down around 20%. But the balanced portfolio was down around 12. And while a 20% drop is twice as big as a 10% drop, psychologically it seems to feel much worse than twice as painful. I know that for many people, declines do not correlate one-to-one with emotional pain. It feels like there is an exponential relationship. And this is actually quite important because as declines get bigger, our fortitude required to stick to our plans follows the exponential emotional pain line. This is what I mean when I say our stomachs overtake our brains when it comes to making decisions when markets are down. All the theory that made sense when things were going well, we start to question that theory. Our brains say, well, if it made sense to hold at a 5% drop, it makes more sense to hold at a 10% drop, otherwise we lock in a bigger loss. But around 15 to 20% or more, our stomachs say, hey guy, do you want me to not throw up right now? Then you should sell everything. When we look in the rear view mirror, it's our brain doing the looking. And so past crashes just look like data. There's no uncertainty when looking at the past because we see what ended up happening. When we're in the moment, we don't know what is going to happen, and that uncertainty causes anxiety. That's why it's so important to get your portfolio matched to your risk profile, which usually means having a less volatile portfolio than the headline indexes. And while it may not grow as fast as the headline indexes over time, you're more likely to stick to it in bad times. It's sometimes said that the best portfolio is the one that you can stick to through thick and thin. Because while it's tempting to have an aggressive portfolio when markets have been strong, if you abandon that portfolio in bad times, you could end up underperforming the balanced investor who always held firm. So if you have a prudently built portfolio, remember that the losses quoted in the headlines are likely a lot worse than how your portfolio is doing. And it's important to remember that because of that exponential relationship between declines and emotional pain. If your actual declines aren't as bad as the single stock market indexes being quoted in the media, your emotional pain hopefully won't be as great as well. The last mental script number 5, is that doing nothing is not doing nothing. You're doing something. You're sticking to your original plan. If you use a robo-advisor or some other portfolio fund that automatically rebalances, like an all-in-one asset allocation ETF, you really aren't supposed to do anything. And if your portfolio doesn't automatically rebalance, then any new regular contributions could be used to bring you back closer to your target asset allocation by adding to the asset classes down the most. This is also sticking to your plan. And if your asset allocation has really drifted away from your target allocation, you might expect a call from your advisor talking about how rebalancing is part of your plan, and maybe now is a good time to do it. Or you might even consider it yourself. Some people just rebalance on a set schedule once per year, regardless of what is happening in any one quarter. Whether you rebalance based on your asset allocation drifting past a certain point, or you just do it periodically on a set schedule, rebalancing is part of a long-term portfolio plan. Obviously, if you decide to bail on your plan, that wasn't part of the original plan. No one starts investing thinking, I will buy low, sell lower. Other than rebalancing, nothing really should change as a result of short-term market performance. If your plan called for putting money into your portfolio monthly, you probably want to keep doing that too. And instead of second guessing that, maybe now it feels better to keep on doing that. I hope that after hearing some of the mental scripts that have helped me avoid reacting with emotions with my investments, that they've helped you too. Again, all of this is predicated on having a proper plan in the first place. And if you aren't confident about that, you may want to seek out qualified advice and or dedicate some time to study up on it from some credible sources. If you have any mental models or scripts that help you stick with your investment plans, I'd love to hear them in the comment section down below. And I would appreciate it if you would hit that like button, subscribe to my channel, and hit the bell to turn on notifications if you want more content like this. And I will see you in the next video.